Good Saturday morning to everybody, and welcome to Mortgage Matters Radio Show with Rob Weinberg. I'm Gary Byron. Rob, how are you this morning?
I'm doing great. How you doing?
I'm not doing too bad. You're looking good.
Thank you.
I see the nice weather is paying off here, huh?
It is.
Yeah, everybody was waiting for it.
I hope it stays like this for a bit.
I'm right there with you. How was your week?
It was great, and
Good.
The market just seems to be continuing to escalate, and we're seeing a lot more offers getting accepted lately, especially from first-time buyers. I think with the nicer weather, there's starting to be some people putting their houses on the market now.
Yes, I have. It's so funny that you say that, because what I was going to bring up to you was that I noticed just this weekend, there's like a lot of open houses going on. I don't know if people are just moving out of the state or whatever, but they're moving. But the weather does have a lot to do. You don't see many open houses in February, let's say.
Not as many, because people don't like to trek in ice and snow to do that. So the nicer the weather gets, the more open houses. And like I said, the more activity. I think somewhat the pandemic may play in, because people don't want others trekking through their house with not knowing the health situation and whatnot.
Well, that's true too. You're right. We have to, but so it's a combination of the
Definitely,
COVID
and I'm
being
hopeful
lifted,
that over the next couple of months, as we get into the summer and the fall, we're going to see people that were on the fence about listing their homes and start to actually put those homes on the market. But it's a double-edged sword, because they sell their house at a great high market value, but now they have to buy their next one as well. So some of them are moving out of state, moving to lower cost areas, because they are going to have to get into the current market as a buyer if they're selling at this time.
So let's go into that. Let's talk about using your equity then to invest in real estate, since we're talking about real estate. So, what's the first step? What's the first step to building a real estate portfolio?
So a lot of people come to me wanting to be real estate entrepreneurs. They want to be a real estate millionaire. They've heard about the success stories, because I believe 90% of millionaires in the United States, it's a result of real estate. So with that said, where do you start? You start by buying a primary home. You don't just want to go out and buy an apartment building or buy an investment property immediately. That's getting in a little too quick, too deep. What you want to do is you want to buy a primary home. That could be a single-family home or a multifamily, a 2 to 4 unit property, where you're going to live in one unit and rent the others out, as we've talked about on previous shows. If I could do it all over again, that's where I would start. I'd buy a 2, 3, 4 unit home, live in one, not forever, just for a couple of years as you're starting out, and rent out the others, because ultimately that can be turned into your first rental property, your first cash cow that can start building equity and paying the mortgage. So step number one is buying that first primary home. The second step to that is paying that mortgage down and building equity over time. Every single payment you make to the mortgage company, there's going to be a piece of that that's going to principal and a piece that's going to interest. The interest part doesn't matter. That's not yours. That's the bank's. But the principal part, at first it's very small.
Yeah, it is.
May only be a couple dollars a month. But as you move through that amortization schedule in the mortgage, once you have that mortgage a couple of years, and some examples we'll talk about, you start building equity quick. You might be paying $1,000 a month on your mortgage, and $600 of that is going to principal. That's like a savings account in the walls of your home. So the other piece of it is that the home value is going to fluctuate, and in most cases, the home value is going to go up over time. When they look at the last century of real estate prices, they have historically gone up quite a bit over time. So as that mortgage is going down and that value is going up, the gap between those two, the mortgage balance and the actual value of the home, that's your equity. That's what we're going to talk about using to create wealth.
So how much equity then does somebody need in order to implement these types of methods?
So you can't borrow all the money in your home. Side note, if you're a veteran, there are specific programs that let you borrow more than the options we're going to talk about.
Okay.
90, even in some cases, 100% of the value.
Oh.
Other than if you're a veteran and qualify for a VA loan, you're going to be capped at, depending on the type of property, 70 to 80% of the value of the home. So if you do the math, you're going to need to have anywhere from 20 to 30% equity in your property in order to implement these type of methods. So that's really the minimum, okay? And these loans are always changing. The guidelines are changing. I remember when I started on an FHA loan, you could borrow 95% of the value on a cash out refinance. Then they lowered it to 90%. Then they lowered it to 85%. And where we stand today, it's just about not even a year and a half ago that FHA made a change where now they only allow you to borrow 80% of the home value. Conventional loans are the same. So just to reiterate, you need 20 to 30% equity to do that. It's not going to happen overnight. It really is not. It's going to take a combination of the value of the home going up and you paying down that mortgage. Unless you put a really big down payment at closing, some people do, but most first-time buyers are putting lower down payments. 3 to 5%, maybe 10%. So it is going to take several years, in most cases, to build that amount where you can refinance or put a mortgage and take that equity out.
But buy your primary house is what you're saying here. Buy the home you're going to live in first and build equity.
You got to live somewhere. You have to have a roof over your head. You're either paying your own mortgage or you're paying your landlord's mortgage.
Oh.
Where would you rather build equity for yourself
or
your own? And in a lot of areas of the country, and even in Connecticut here, depending on the town, you can rent a house for the same or less the same or more than it would cost for buying. So it just makes sense to buy because you might actually be able to save money on a monthly basis.
So then, but how long does someone need to live in their home then before using their equity? And what impact does the length of time that they have been in their home have?
There are a few exceptions, but 99% of people are going to need to live in that house for between 6 and 12 months. That's going to be the minimum. And the reason is because depending on the loan program, Fannie Mae, Freddie Mac conforming or conventional loans will go off the current value once you've lived there for 6 months or once you've owned the house for 6 months. So if you bought a house for $200 and you got a good deal and it's worth $275, after 6 months we can get the house reappraised and go off that current value. On an FHA or government loan, it's a 1-year waiting period. So you have to live there for 12 months or a year. You have to have owned the property in order to actually cash out equity from it and use the current value, I should say.
All right, you had said something a minute ago that you were saying you buy your home that you're going to live in first, build some equity, and then if you want to buy a multifamily home, go for it. What if you decided, though, to buy the multifamily home first, but live there for a couple of years? Even though it's a multifamily home, that's recommended as well, though. I
would say that's the best idea.
Yeah.
You know, a multifamily is a great strategy to start with because especially if you are starting out and you don't have a big family and you don't need a big single family home, you know, a 2 to 4 unit property is great. You can get a 2 or 3 bedroom in each unit and live in one and rent the others out, and those tenants are helping to pay your mortgage. Then once you're ready to settle down, have, you know, more kids and really start a growing family, then you can move to that single family property and you can then rent out the unit that you were occupying. And all these strategies we're talking about as far as using the equity in your home, they can be implemented on any type of property. I will make a side note and say that a 2 to 4 unit home is more restrictive than a single family when it comes to pulling equity out, but there are some different program options that are available for that. And you can still, in most cases, pull out, like we said, 70 or even 75% of the value of the home. So people that have bought homes in the last year in Connecticut, a lot of them are implementing this stuff right now because the home values have skyrocketed almost in every city, in some double digits percentage-wise over the last 12 months. So if your house was worth $200,000 a year ago, it might be worth $250,000, $275,000 plus. Now there's equity in there you may have not even realized you had. Equity that you can use for a lot of different things, like we've discussed on previous shows, debt consolidation, home improvements. But for the purpose of right now, we really want to concentrate on using that equity to build wealth, taking that equity out and putting it somewhere that you can invest it in another property or in some sort of other investment that will allow you to actually get a return on that money.
Give me some real examples. All right, maybe clients. You don't have to mention any names. Just some real examples of people who have used equity from one property to buy another.
Absolutely. I have some really great stories. I know we're limited on time, so I'll just touch on a couple that are really top of mind because they're all in the last 90 to 120 days that have implemented this stuff. Okay. It is so top of mind right now, the way the economy and the real estate market is. First gentleman is from Vernon, Connecticut, young guy in his late 20s. He had bought a 4-family house in 2017 for $195,000. He put 3.5% down. Very low down payment, okay? Just a couple years ago. He's got 26 years left on his mortgage before he came to me. We refinanced. We got an appraisal of the house today. The one he bought for $195,000 with 3.5% down. Now it's worth $270,000 today.
Oh, wow.
That's the current market value. What we were able to do was refinance him on an FHA loan because that gave him the best ability to pull the most equity out. He pulled out $30,000, which is more than he even had invested in the property at 3.5% down with his closing years ago. So he got a very good return, and now he's using that money to put down on a rental property, his next property that he's going to be renting out. Of course, with it being a 4-family, he lives in one unit, exactly what we're talking about. And he rents out the other 3, and the other 3 more than cover his mortgage, even with the additional cash out that he took. So that's one example. Another one is an older family that's nearing retirement in Hartford. They've lived in their home for 20 plus years. They actually only had 8 years left on their mortgage. They had taken a 15-year note on their loan, on their home, I should say, and they had 8 years to pay left on it. So they had a lot of equity built up. What we did with them was kind of a two-step or a two-pronged strategy. Number one was we used their equity to pay off all their debt. They had some personal loans and auto loans. We paid off all their debt. And on top of that, handed them $80,000 in cash at closing that they're using to now buy their retirement home. It's going to be a vacation home for now, and in a couple years they're going to move there as their primary home, and they're actually buying this property down in Florida. That's where they ultimately want to move to. So that $80,000 is going to be enough for them to put down and all their closing costs on their dream home in Florida. And again, their debt is completely paid off. We just put them back on a 15-year mortgage. Wow. When we look at the debt that was paid and the amount of their new mortgage, their payment net to them actually went down by $400 a month.
That's incredible.
So that $400 a month now is their nut to start that they can put more away in savings. And then ultimately when they buy the house in Florida, that's a huge leg up on that new mortgage because $80,000 is not going to buy you a house in cash.
Right.
Okay, they are going to have a new mortgage, but they're $400 ahead from the beginning. So like I said, they can now apply that savings to the new mortgage payment. And then the last example that I'll give you is a middle-aged couple in Thomaston, Connecticut that came to me. They as well had a 15-year mortgage with only 6 years left. And they really had a hard time. Took a few months of our conversations and strategizing to get them comfortable with going from 6 years to pay off their home. They have no other properties right now, and take them back to a 15-year mortgage. But what we were able to do, this is going to blow your mind. We took them back to that 15-year mortgage. We dropped their interest rate, of course. On all these scenarios, we dropped their interest rate. We pulled out $75,000 that now they're going to use to buy another property. And their payment actually went down by $250 a month. The key, as you'll be hearing these last couple scenarios I've given you in real life stories, the key was that they took a short-term mortgage or they paid extra on their mortgage. They built all this equity. People that are constantly, paying the minimum payment or refinancing all the time and not building equity, you're not going to be able to implement this. It may take several years, 2 to 5 years in a normal housing market for you to build enough equity to do this. But these ones that are just mind-blowing, they paid their mortgage down aggressively. And that's what gave them, though, the opportunities to tap that equity now. When the home values are high, let's go in, let's pounce. Now's the time.
Those are great stories, Rob. In fact, they're inspiring stories. How about discussing maybe a few ways a home flipper or even a renovator could use these same strategies?
Amazing opportunities for home renovator and home flippers. So there's a specific method that, it can be looked up online. It's a very common method. It's called the BRRR method, which stands for buy, renovate, refinance, repeat. Okay, you can look it up, BRRR. So that's how a home flipper or renovator can use these. Is I just had a gentleman that I worked with who bought a condo in cash just 6 months ago. He did a little bit of work to the property. He has a tenant in there. It's an investment property. And it's doubled in value since he bought it. Because, again, a little bit of work he put in. He got a great deal when he bought it. And again, the market, of course, the market going up so much. So he did exactly this. He bought in cash. He did a little renovation. Now we did the third step, the refinance. We used the current market value of the property. He pulled out all of the equity that he originally put in because he bought in cash, and then another $30,000 on top of that. So now he's got this nice nut, this nice nest egg, and now is the last step of the BRRR method, which is repeat. So he's just going to go and do this again. Buy in cash, renovate. He's going to come to me. We're going to refinance the property after 6 months. He's going to have a tenant in there, and now he can repeat this. And this is a gentleman that's very young, just starting out, and he understands these strategies. He knew that there was an opportunity here. He just didn't know how to implement it. He found me online. He found me on YouTube through some of the videos that I have on there about these methods and reached out to me, and we were able to put this customized plan together for him. So home flippers and these renovators, you see there's a huge opportunity for them, especially when you look long term, not only at this property, but how can we build this out over several properties in the course of a few years?
You know what I find interesting in listening to these stories is that this is not necessarily a young person's game. I mean, you're sure we can both kid each other, or maybe there's some truth to it where you say, man, if I had known now, or if I had known then what I know now. But in listening to this, you spoke about a middle-aged couple. You told about somebody who had paid most of their home off, and they only 15 years or 8 years. You really can be any age to get into this. I mean, it's better. Sure, anything is better when you're younger. Of course, investing is better when you're younger.
Start younger, and you'll have these big opportunities. These people that we're talking about that had 6 years, 8 years left on their mortgage. Few years ago, they weren't in this position. You look to when they started, they just knew, hey, building equity is good. I want to do that. They didn't know when they took a 15-year mortgage 6, 7, 8 years ago that they were going to want to use the equity to buy another house. That was not in their deck of cards at that point.
Right.
But they knew building equity would give them opportunity. Now their life is changing. The economy is changing. The market's changing. But because they've been disciplined in paying their homes down, in building that equity, and then had a little bit of luck here with the market going up so much recently, now is the time to pounce on the opportunity. But obviously, the earlier you start, the more opportunities you're going to have, the more time you're going to have to get all this done.
Folks, you are listening to Mortgage Matters Radio Show with Rob Weinberg. I'm Gary Byron. You can get a hold of Rob if you like what you're listening to. I know I do. Oh, my goodness. I'm sitting here going, oh, my goodness, I've missed the boat on so many things. Well, maybe on some things I didn't, though. 860-413-3938. Once again, it's area code 860-413-3938. Are there places that someone can invest their money or even equity if they want returns from real estate without dealing with tenants or property maintenance? Just, especially with COVID, there's a lot of forgiveness that's being offered by the government where some landlords aren't getting paid.
There is risk, of course, with any investment.
Sure.
And especially a newcomer to real estate investing, it can get a little bit it would make you nervous to be needing to rely on a tenant. Are they going to pay or not? So, and at one time in my life, I was actually in that scenario as well, transitioning, moving and whatnot. And I was looking for ways to be able to get exposure to real estate without needing to buy one property and do what we're talking about and go through this process. And now with technology, there's some great options where you can invest in real estate with as little as even $500 or $1,000. You can get access to returns from real estate. And I'm going to give you some websites here that can be looked up. You can plug them into Google or just go online. And these are websites for what are called real estate investment trusts. So these are like a mutual fund of real estate, kind of like a stock, but the ones I'm going to discuss are private, so you can't trade them on the stock market. They're private funds that manage, buy, sell, renovate real estate, commercial and residential real estate. And you can get a piece of those returns. They're investing in office buildings. They're investing in multifamily. Some of these deals are multi-million dollar deals. You may only have $1,000 in, but they're buying a $15 million office building. You can get a piece of that with these strategies and with the different sources I'm going to give you. So one source, and I've invested in all of these myself, I will tell you, one source is Modiv, M-O-D-I-V. It used to be called Rich Uncles, It's a group of very seasoned real estate investors in California. They invest all throughout the country, mainly commercial real estate. And they've averaged, I believe, somewhere around 6 to 8% returns for many, many years. They're very seasoned with this. And you can put in as little as $500 to $1,000 in with them and get access to their portfolio of properties. It's all tracked online. It's easy to track. And, your investment, your returns, they direct deposit money into your bank account consistently to get your return. So that's one option. Another is called Diversifund, Diversy Fund, Diversifund.com. And Diversifund is very similar. It's like a mutual fund of real estate. It's a newer company. I think they've been around a year to 2 years. They're doing the same thing where they're buying and renovating and, giving value to real estate. Mm-hmm. And they also have very good returns on this that you can get involved in, even with just a few $100s. Another great one that I've invested with heavily over the years is Fundrise. Fundrise, fundrise.com. They have a bunch of different mutual funds of real estate. I shouldn't call them mutual funds because that's the wrong word, but they're funds of real estate. Okay. So you can get involved in their West Coast fund, their East Coast fund. They have all these different funds of real estate where they're buying everything from land to sell to developers, to office buildings, to single-family homes that they're going to rent out and get rental income. They have a very long track record. Many, many years, I believe, of 7-8% returns. These are the type of returns that most people end up getting on rental properties over the course of time. So to be able to do that and not have the same risk, there is risk, but you're not dealing with tenants, you're not dealing with toilets, you're not dealing with repairs, you're not dealing with the day-to-day collection of rent. It's 100% passive. And two last ones I want to throw out there is RealtyMogul.com, just the way it sounds, RealtyMogul.com. They have a few real estate investment trusts that they have on there that are, one of them invests in multifamily properties, like we're talking about, apartment buildings and things of that nature. And the other one invests in all sorts of commercial real estate, office buildings, strip malls, things of that nature. And they have between 4 and 6% returns consistently. Plus, you get a kicker on the back end when they sell properties. Most of these you do when there's profit and exit. So some really good. And the last one I'll give you is fundthatflip.com, fundthatflip.com. So you can actually invest alongside home flippers all over the country, and you can give them as little as a couple $1,000s to get involved and get those returns.
Rob, what are some of the most important things that you need to look at in a good real estate investment?
I think the number one thing is you need to look at what is the income that this property is going to generate? What is the market rent that this property is going to bring in? And then what are the expenses of the property? So we're talking about if you have a mortgage or are going to need to get a mortgage, the debt service on that mortgage, the property taxes, the home insurance. If there's flood insurance, that can be a big piece as well. And then the big piece people miss is you want to budget for maintenance. Things happen with property. You don't just have a house for 20 years, nothing goes wrong. You need to budget sometimes even 10, 15% of the actual income coming in to go towards that maintenance of the property. The older the house is, the more you need to budget for maintenance. And the other thing would be vacancy rates. You can't rent a house 24/7, 365 days a year. What about when one tenant moves out? There may be a month or a couple months before the next one moves in. You're paying the bills during that time. So you want to start out by saying, what are my expenses going to be on this property? And what is the income going to be? And is there a big enough profit margin to make it worth it? Are you really going to go through all of this to make $100 a month?
Of course not.
And especially as prices continue to escalate, is it even worth it? A lot of my real estate investor clients are sitting there getting their capital ready, doing these refinancing strategies, taking the equity out, ready to pounce when the right opportunity comes up.
I totally get it. Got time for maybe one more question before we wrap things up here. Really quickly, at what point do you think someone should really start thinking about building a real estate portfolio?
Like we said at the top of the show, I think getting that first property is key. So you want to have your first property. You want to feel comfortable with home ownership, with paying a mortgage, with maintaining the property taxes, etc. And then you want to look at, once you're at that point, what is it going to take to get to my next property? Like I said, as early as 6 months. After you buy that first property, get with an advisor and someone that can show you these strategies. I'm happy to help. And then we can say, here's what needs to be done. Here's what your property needs to appraise for to make this happen. Here's how much you need to pay down the mortgage. Sometimes it may not be possible immediately. We may need to wait a couple of years. Then you want to start saving money towards the down payment to supplement the equity that you're going to get. Nobody ever says I save too much money, especially when it comes to real estate. When you want to do renovations and like we're talking about maintenance and this and that, the more savings you have, the more flexibility you're going to have. What if you find that dream property to invest in and you're 10,000 short in the equity we pulled out of your primary home? That's going to be a tough nut to swallow, but it'll be a lot easier if you have that money saved on your own, separate from the equity. So if you're interested in more passive strategies and you only have a small amount of money, start out with these ideas we were just talking about, the real estate investment trust, the passive income, where you can put in $1,000, a couple $1,000s into these and actually get returns. That'll help you dip your toe in the water before you actually get that next home.
Yeah. Oh, boy. I learned so much. You're so inspiring. You really get everybody pumped up. I know I can certainly tell you how pumped up I get every time. And at the same time, I always get a little regret where, why didn't I start doing this earlier? But, it's good to know that really some of these ideas that you've given, that you've provided here just this morning alone, you can really start implementing at any age. Folks, if you've got a question that you would like asked on these very airways to Rob Weinberg, in fact, maybe even next week, simply email us at mortgagemattersradioshow@gmail.com. Again, it's mortgagemattersradioshow@gmail.com. We'll get your question asked on the air next week. If you would like to do this, check out Rob's website, www.robgw.com. I always start there. Some of my questions get asked automatically. Of course, it also sparks other questions in my mind, but that's okay. That's why I give them a call. Again, it's www.robgw.com. And if you'd like to make an appointment or maybe just ask him a few questions, let's get the ball rolling. Like he said, at least start now, even if you want to do something down the road. It's very easy. Write down this phone number. Could be one of the most significant phone calls you make this year. 860-413-3938. I'll repeat that for you. 860-413-3938. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters Radio Show. Until next Saturday morning, have a good one, everybody. So long.